All right, Bulls and Bears, we're back with another dose economic reality. A lot to talk about today, a lot to get caught up on. We've got escalating war situation. We're going to get into that, how you should brace for that. We also have the home price index that many people follow has showed a negative number now for the first time in 2 years. So home prices dropped for the first time in over about 2 years. And this is in the spring, what's known as the spring selling season. It's not so much of a selling season, it's more like a non-sale season. So we're going to get into that further weakness in the housing market and a lot more, how consumers are holding up against this high cost of living, right? So let's go ahead and get started though right here. We have stories out there like this, the war over in Europe. Remember, a few months ago, we were told that this war was going to be stopped within the first few weeks of the new administration. And it hasn't happened, has it? No, it's escalated. And we've got U.S. troops actually involved here, boots on the ground, actually, U.S. over there, just outside of the border here of those countries. And it's going to continue. I think it's going to continue. I don't see any stopping this. And I was the one that told you many times. I've told you, trying to think how many times, it's too many to count, that what we're being told that was going to happen is not going to happen. The wars are not going to end. The cost of living is not going to come down. The only thing that's going to bring these things to a halt is a complete restructure of the financial system. We're talking about the way money is put into existence or created into existence and put into the economy. Outside of that, it's going to be more spending on weaponry. Wars are going to escalate. Cost of living is going to remain elevated. It may come down a little bit here and there, like the housing market. We'll talk about that in a minute. But overall, the cost of living is going to remain elevated because of the way the banks are operating right now. So we'll get into more of that in just a few minutes here. But first, let's go ahead and get into the housing numbers here. And this is the Case Schiller Home Price Index, folks. We see the negative number, first time going all the way back to early 2023. Actually, so it's been over 2 years now since we saw a month-over-month price decline. Now, why is this very significant? Because this is the Case Schiller Home Price Index, which just focuses on major U.S. cities, in this case, 20 U.S. cities. And those are the cities, the larger cities are the places you usually see prices remain sticky because that's where most of the jobs are. But when you look across the country nationwide, prices are coming down, and they're down pretty severely from the peak, down about $20,000. Now, we're not seeing that severe of a price drop yet in the major cities, but we're starting to see negative numbers come up. Now, what happened after 2022, early 2023? We saw the prices decline there. What happened? Well, more easy money was pumped into the system here, and even though interest rates are higher, they made it a lot easier for people to borrow money. They lowered the standards for lending. And of course, you still have the billionaires out there buying more homes too, compared to just the middle class working people. And that was enough to keep home prices propped up. We also have not enough new construction to keep up with the rising demand. But what could be happening now is the people now leaving the U.S., it's starting to cause rents to come down. And we're starting to see that bleed over into the housing market, right? We're going to get into that more in a little bit. But first, let's look at some numbers here out of some cities that are actually down even more severe than this chart shows. And this was put out here by Wolf Street recently. And we'll pull up a chart here of each city here. The most severe is Austin, Texas, folks. They went from about 715,000 down to about 555,000, folks. That's a huge, huge drop there over in Texas, Austin, Texas. Oakland down severely from the peak, from about 1.2 million down to about 840,000, according to my estimate here, just looking at the charts. And that represented a 3.7% year-over-year drop, but it's even more severe when you look at compared to the peak, which was late 2022 for Austin here. A few more to run through. New Orleans down severely from the peak. I'll just bring up the charts from the rest of them. If you want to check out more specific numbers, just go over to Wolf Street. San Francisco down very severely from the peak. There's another one. DC, another one. Phoenix, we saw a drop and then a recovery. Now a drop back down, but still down severely from the peak. Portland, Oregon, big spike there at the end of 2022. A lot of people got into the housing market before interest rates went up. Remember, that was the big surge that we saw before mortgage rates went up. People did expect a bigger price drop, though, with the higher mortgage rates now being about 7% and higher. But we didn't see that because of the reasons I just mentioned and what we'll get into here in just a few minutes. A couple more here, though. Denver, another one with a big price drop from the peak. Fort Worth, Texas, San Antonio, Texas. So there you go, folks. Further weakness in the housing market. What's keeping this market propped up, folks? It's the system of money, and it's the ability to just create this money out of nothing, folks. That's what's continuing to keep it propped up. Remember, 2008, the banks were on the verge of an implosion. People were afraid, and people weren't able to borrow money to buy homes to keep the bubble inflated. It's just the opposite now. The banks are guaranteed endless life support, so there's no fear out there. There's no fear that the market's going to implode because of what we've heard now for several years, that the banks are going to be propped up no matter what, right? And that's the big thing. Now, there's many other factors involved here, but that's the number one thing that underpins this whole thing. But you also have the construction factor. Back then, 2007-8, there was a huge amount of construction put on the market. Builders anticipated the boom that would never end. Prior to the housing bubble bust, there were talks out of experts that the housing market could never come down because people always need a place to live. Yes, that's true. But when you have speculation and then massive construction, things can come down, but you have to have the banks creating the fear and the panic before the housing market comes down. That's not happening right now. A few years ago, we had some smaller regional banks fail. That wasn't enough to really stop the housing bubble from going bigger, from blowing bigger. Because what happened back then? Well, the banks got rescued. The depositors got rescued. The banks got bought out, in other words. The depositors all got rescued, and they really stamped out the fear that would have been would have spread throughout the housing market, throughout the economy, not just the housing market. The contagion was contained. There was no contagion because, again, they came in with easy money. They rescued the depositors. Even though FDIC didn't have enough money to cover the depositors, they came in and just printed the money digitally, with the Fed and the Treasury both getting involved here. So, folks, that's what's a lot different between now and back then, and that's why you haven't seen the housing market go bust. And what we're finding out here is a lot of the rescue programs that were implemented back in 2020, when really the housing market should have crashed worse in 2020 than it did in 2008, 9, and 10, but they kept the floor under home prices because they kept people in their homes with all the relief programs, helicopter money. But we saw the consequences of that, which is massive inflation and cost of living rising. Well, look what they're having to do now in different areas. They're having to give relief to people. Los Angeles County begins first wave of medical debt relief. People can't keep up with their debt payments. I think student loans are next. From a federal level, we're no longer keeping the student loans from having to be paid back, right? So the federal funding or assistance with this is done, but we're going to start seeing more local things happen now. Los Angeles County is doing it with the debt relief. That's just a more recent story. Will we see states help out their residents with student loan debt? That's what's going to be next. And can states afford this? Well, many of them can't. I mean, we know that a lot of states are running in the red, just like the U.S. is running deficit year after year after year. Deficit's getting bigger and bigger all the time. Can states actually do this without the federal funding? How are states going to continue to help their people? In this case, medical debt out of Los Angeles. And it's going to go county by county, even city by city. Los Angeles County is the one doing this medical relief, but you get the picture. There's local things happening that are going to try to help their people, but I don't think it's going to work because once the federal funding gets pulled back, then the states and counties and cities can no longer keep it up. You know what I mean? And we see something similar happening in Illinois. How Illinois is confronting the student loan crisis. $63 billion in collective student loan debt for people in that state. New forgiveness programs and innovative solutions aim to help borrowers, but state funding and public awareness remains an obstacle. So if the states aren't getting the funding, then how are they going to continue to help their citizens, right? So you're going to see certain states really see a lot of problems come up here. There's already a lot of problems. I mean, look at the homeless situation, look at the debt levels, look at the delinquencies rising, not just certain states, but across the nation. But some states will be worse than others. And we're going to find out, I think, before the end of the year, which states are not able to keep their citizens from financially imploding. And folks, most of you know it's not just a U.S. problem. This is a global problem. Canada has a big cost of living problem, major housing bubble up there, people buried under debt. Well, look what just happened in Canada. Look what just came out. Delinquencies reached levels not seen since 2009. And this is non-mortgage. So this is everything from credit cards to car loans, delinquencies in general, not counting mortgages, the highest level since 2009. Housing is also seeing problems up there, but not as bad as the non-mortgage debt. Highest level, so what is that? Is that 16 years up in Canada, folks? So this is worldwide. 1.4 million people in Canada missed a credit payment as refinancing and renewals dominate the first quarter mortgage market. And folks, I think ultimately we're going to have to see some sort of sweeping debt, not just debt forgiveness, debt erasure program. I mean, something that we've never seen on a widespread scale in this country, and I think other countries are going to be in it as well. There's going to have to be massive debt forgiveness. There's no way to ever pay off this debt as individuals, cities, states, the entire country, the global debt. There's no way to ever pay it back because, again, it's money just created into existence at the click of a mouse. And on to some other news that I think is really going to back up the fact that consumers are really struggling right now. Durable goods orders just declined 6.3% in April. New orders for manufactured durable goods in April down following 4 consecutive increases. Decreased 6.3%. According to the U.S. Bureau, announced this 7.6% in March increase. So up in March, down in April. Excluding transportation, the new orders decreased 7.5%. Transportation equipment also down, following 4 consecutive monthly increases. And folks, I mean, it's got to come to a boiling point at some point, and people are going to have to jump out of the water, folks. I mean, you can say that this is going to last forever, and that's actually the scary part. If they keep these bubbles inflated forever, if they don't let the cost of living come down, even though it's going to look bad for them, because remember, the ones running this, if the bubbles burst on their watch, that's going to make them look bad. Because all the metrics that are used to gauge if the economy is growing or not are based on price increases, higher cost of living, nonstop. And as soon as that ends, as soon as the cost of living comes down, as soon as deflation happens, then you see the economy is declared as failing, in a recession and all that. So they don't want that to happen, folks. So could that be the reason why we're seeing this escalated war and the U.S. involvement now to try to cover this whole thing up? We know that in the past, economic downturns have often happened in conjunction with intervention in foreign wars, right? So could that be what's going to happen in this case? I mean, I'm not saying it is or isn't. I'm saying just be on the lookout for it. Could that be the black swan that they need to bring this whole thing down as well? And some of you might know we're also doing other things to try to help people because of the enormous debt that so many people are under. We're trying to get rid of taxes on overtime, get rid of taxes on tips, because these people working in these service sector industries and just in general, they can't keep up, folks. So I think it's going to be too little, though. I think we're still going to see debt continue to climb. They're going to pull lots of rabbits out of the hat trying to keep this thing from imploding. A lot of forgiveness programs like we're seeing in Illinois recently, Los Angeles County, relieving certain types of debt. And they're going to try to tinker with the system as it is, but it's not going to work, folks. It's going to be a continual struggle for people that are already struggling in debt, unable to keep up with the cost of living. It's likely going to get worse. But if you invest wisely, you can stay ahead of this. I've got some digital assets that are exploding. Stocks are doing pretty good. I don't have many stocks right now. As many of you know, I'm very low in my stock positions, waiting for the big fallout, waiting for the big snap moment. And if we don't get it, that's even worse, because if prices continue to climb, if markets don't come down, it's much easier to invest when prices drop, put it that way for me. I'm waiting for a big drop, folks. Could be years down the road, or it could be right around the corner with this war. Please let me know what you think about this, and how are you investing? Are you in mostly cash like myself, or are you all in? Are you pouring it in because you know the money machine is going to continue to go to no end? Please let me know down in the comments, everybody. As always, keep stacking. Bye for now. Peace.